China's debt story is of incredible global importance and moves fast. So here is the core data in rapid-fire sequence and a roadmap of where we are heading. First, the headline scale, then why the government column looks light on paper but heavy in reality, then how corporate leverage, especially in state firms and property giants, became among the highest on Earth. Next, how households join the party through mortgages. Then the role of local all-government financing vehicles that sit in the gray zone between public and private, followed by the post-2008 explosion. The three red lines: shock, defaults that shook global markets, the policy firefighting that now defines Beijing's day-to-day, the growth hit already visible in trade and commodities, and finally, keep listening, because each slice sets up the next one, and none can be skipped without missing essential context. Start with the headline, add every explicit and implicit obligation, and China now sits on public debt of roughly 115 to 120% of gross domestic product, corporate debt near 120%, and household debt a bit above 60%. Translating ratios into renminbi, that means the state apparatus, all levels, all vehicles, owes something in the low to mid $8 trillion range. Companies add another similar amount, and households tack on around $11 trillion worth, although almost all of it is owed inside the country. The International Monetary Fund emphasizes that these obligations are paired with extraordinary state assets, but even the fund concedes liabilities are outpacing assets at a speed that limits growth. Keep that in mind as we break the pieces apart. Government first. Beijing's central treasury officially owes only about 1/4 of annual output, a lower share than Washington, Tokyo, or any large European capital. That lean top-line number is often quoted by officials as proof there is fiscal space, yet drill down one layer and each province has its own books. Add their explicit bonds, and the general government moves above 80% of gross product. Drill down again into thousands of local government financing vehicles, entities that borrow against future land sales or toll revenue to build roads, subway lines, stadiums, and you discover another mountain of loans roughly half the size of the whole economy. Combine them and public leverage looks similar to advanced economies that enjoy far higher per capita incomes. The state's own audit office warned last year that interest payments on many vehicle loans already exceed the cash flow generated by the underlying projects, meaning rollover risk is rising. Corporate leverage is next, and here the numbers startle even seasoned analysts. Non-financial companies owe the equivalent of roughly 120% of national output, and if banks, insurers, and brokers were included, the share would pass 3/4 of the world's second-largest economy. Two structural features explain the size. State-owned enterprises dominate heavy industry and enjoy near-automatic access to credit, and property developers once fueled the country's most visible boom. State firms tend to earn thin returns because policy objectives outrank profit, so they borrow to bridge the gap. Real estate developers until recently could sell apartments before building them, plow the cash into more land, and rely on endless price appreciation. The cycle broke when regulators introduced the three red lines in mid-2020, capping debt to assets, net gearing, and short-term liquidity. Since then, Evergrande, once the titan of housing, has collapsed with liabilities above $300 billion. Country Garden has restructured tens of billions, and the spillover to suppliers, homebuyers, and local tax revenue has yet to fully play out. Foreign creditors have taken haircuts that remind Wall Street just how thin legal recourse remains in Chinese courts. Household leverage still looks modest beside the developed world, but the speed of increase has surprised many. 2 decades ago, Chinese families had scant access to mortgages. After Beijing liberalized housing credit, banks rolled out 20 to 30-year loans and urban households loaded up. By end 2023, household debt hovered around 2/3 of GDP, almost all mortgages. The ratio of debt to disposable income is roughly 140% in big coastal cities. That matters because consumers with big mortgage bills are reluctant to spend on cars, travel, or services, blunting the country's hoped-for pivot from investment to consumption. Mortgage prepayments accelerated last year as families tried to shrink balances in response to falling property values, an echo of the negative equity hangover the United States experienced after 2008. Local government financing vehicles deserve special attention because they straddle the public-private divide. Provinces cannot legally run deficits beyond modest limits, yet they face political pressure to hit growth targets. Vehicles let them borrow off-budget, often pledging land as collateral. The People's Bank of China calculated that interest on vehicle debt already consumes 1/5 of some county fiscal revenue. Banks continue to refinance these entities because they assume an implicit guarantee, yet several small-scale defaults have broken that assumption in the past 18 months, pushing yields on weaker vehicle bonds well above sovereign levels. The central government responded by allowing provincial swap programs in which new low-coupon bonds replace older high-coupon vehicle debt, but only if provinces disclose the liabilities. That carrot-and-stick approach has coaxed some transparency, though analysts at Standard Chartered say the majority of liabilities remain opaque. Now, the historical timeline that created today's overhang, pre-2008 China was levered but manageable. The global financial crisis hit external demand, so Beijing launched a credit-fueled stimulus equal to roughly 13% of GDP in 2009 alone, dwarfing most other countries. Orders went out to build railways, airports, steel mills. State banks lent, local vehicles borrowed, and debt soared. By 2013 then, Premier Li Keqiang publicly flagged the need to cool things. Macro-prudential tightening cycles followed, shadow banking was squeezed, interbank leverage curbed, trust products scrutinized. But each time growth slowed, policymakers eased again, a pattern repeated in 2015 after a stock market rout and again during the pandemic shock. COVID cannot be skipped. Lockdowns crushed services in 2020, export orders surprised on the upside, and authorities doubled down on infrastructure spending. They also imposed the 3 red lines on developers to forestall a property bubble from metastasizing into a systemic crisis. Critics argue the timing was unfortunate. Cutting developer credit while consumers were stuck at home froze a large chunk of activity. Supporters insist the pain was unavoidable and delaying would only have worsened the eventual bust. The debate continues because the property market still accounts for roughly 1/4 of gross domestic product when construction, materials, and adjacent services are counted. Defaults spread beyond property into shadow banking last summer. Zhangji, one of the largest wealth management conglomerates, missed payments on high-yield products sold to middle-class savers. Social media lit up with video clips of angry retirees demanding refunds. Regulators quietly organized balance sheet audits, froze founder assets, and instructed state entities to take minority stakes, preventing wider panic. This method, targeted rescue, limited disclosure, moral hazard concerns but systemic calm preserved, has become the default playbook. Meanwhile, growth has downshifted. 2023 posted 5.2% real expansion, enough to meet Beijing's public target, though barely half the pace enjoyed a decade earlier. The International Monetary Fund projects a glide path toward the low 3s by the end of the decade, a consequence of shrinking working-age population, slower productivity, and, yes, the debt overhang. Commodity exporters from Brazil to Australia already feel soft Chinese demand. Iron ore prices, once above $200 a ton, now hover near half that. Copper, oil, and liquefied gas markets show similar patterns. Lower input costs help curb inflation in the United States and Europe, yet they also dent the earnings of multinational miners and drillers. Financial contagion beyond China's borders remains limited because foreigners hold only a sliver of the risky paper. Offshore dollar bonds issued by Chinese companies make up a small share of global high-yield indices. Portfolio managers who ventured in chasing yield learned hard lessons when covenants proved weak. The bigger channel of transmission is sentiment. Headlines about Evergrande court rulings or Moody's placing the sovereign on negative outlook spark global market wobbles, even if actual losses are contained domestically. Policy response deserves close tracking because each tweak shapes the next 6 months of data. The People's Bank has trimmed its 1-year loan prime rate twice since mid-2023. Each cut 10 to 15 basis points and shaved reserve requirement ratios for banks to free up long-term liquidity. The Ministry of Finance raised the official deficit ceiling to 4% of GDP for 2025, yet bond traders estimate the augmented deficit, including off-budget outlays, near 10%. A new 300 billion renminbi facility lets state-owned enterprises buy unsold apartments for conversion into affordable housing, a move meant to clear inventory without reigniting speculation. Analysts worry that warehousing empty flats on state balance sheets merely shifts rather than solves the problem, but in the short run it props up construction jobs. Debate rages inside China's elite circles about whether to launch an even bigger bailout. Reformers argue for accepting lower growth and forcing losses onto state-owned enterprises, banks, and investors, paired with an expansion of the social safety net to support consumption. Others push for a grand central government-backed restructuring fund that would assume vehicle and developer debt financed by ultra-long sovereign bonds at record-low yields. Voices outside the country, such as the Bank for International Settlements, warn that blanket guarantees could entrench moral hazard. History shows that large state rescues, while sometimes necessary, often leave scar tissue that depresses loan discipline for years. Where does politics in Washington intersect? The previous US administration frequently accused Beijing of currency manipulation while pursuing corporate tax cuts that juice stock buybacks at home. Critics on the left point out that railing against China's credit model from a White House that simultaneously pushed deregulatory agendas for Wall Street rang hollow. Current policymakers take a different tack, mixing export controls on advanced chips with quiet dialogue on macro-financial stability. The Treasury and the PBOC now hold semi-regular working groups focused on contagion risks. Market observers see this as pragmatic. Neither side wants a debt accident in China to amplify global recession odds when climate transition and multiple conflicts already strain resources. Looking forward, 3 scenarios dominate research house playbooks. The baseline assumes muddle through, Beijing contains defaults via selective support, growth slows toward 4%, and debt ratios inch higher but not explosively so. The upside scenario, a decisive restructuring, would involve transparent asset liability mapping, forced write-downs for weak vehicles, and a pivot to household transfer payments to boost consumption. That could reignite confidence and set China on a sustainable 3 to 4% path. The downside, a disorderly unwind, sees cascading local vehicle defaults, property prices melting further, banks tightening credit sharply, and growth slipping below 2%, with significant spillovers to commodity exporters, emerging market currencies, and global equities. Where do odds sit today? Most investment banks place a 2/3 chance on muddle through, 1 in 5 on disorderly, and the remainder on decisive reform. Bond spreads inside China reflect that. Central government 10-year yields trade near 2.2%, the lowest in more than a decade, implying markets still trust Beijing's capacity to pay. By contrast, weaker vehicle bonds now yield 6 to 8%, triple sovereign levels, evidence investors are finally differentiating credit risk. Behind the numbers lurks a demographic time bomb. China's working-age population peaked in 2014. Fewer young workers means slower revenue growth for local governments relying on payroll taxes while elderly care spending rises? That makes today's debt even heavier tomorrow. Labor productivity gains could offset the drag, but that demands higher spending on education and research, not more cement. The latest 5-year plan emphasizes self-reliance in technology, but funding such ambitions alongside debt service will test budgets. Household behavior is the wild card. Surveys by Peking University show consumer confidence still below pre-pandemic levels. Families fret about job security, property values, and inadequate pensions. If they continue to hoard cash rather than spend, the hoped-for domestic demand rebalancing falters. Some scholars advocate a permanent expansion of unemployment insurance, rural health coverage, and childcare subsidies, financed by redirecting subsidies now flowing to heavy industry. Others caution that cutting investment too fast risks a growth slump that would worsen debt ratios. Environmental goals add another layer. Beijing has pledged carbon neutrality by 2060 but remains the world's top coal consumer. Retiring coal plants early implies stranded assets and the need to write off or refinance billions in loans to provincial energy firms. Green bonds could help, yet they still swell the overall credit stock. Western central banks navigating similar green investment questions will watch how Beijing balances climate commitments with debt costs. Finally, transparency, or the lack of it, remains a core obstacle. Credit rating agencies, multilateral lenders, and foreign investors all complain that granular data on vehicle liabilities, bank balance sheet exposure, and government guarantees are sparse. The Statistics Bureau has promised better disclosure, yet local officials fear that revealing hidden debt could trigger immediate downgrades, a classic catch-22. Without clarity, risk is mispriced and capital allocates poorly, perpetuating the very imbalances policymakers say they want to end. In sum, China's debt challenge is immense but not yet fatal. The state still commands vast assets, controls the banking system, and holds nearly $3 trillion in foreign reserves. That arsenal gives it time, yet time alone does not pay interest. Decisions taken in the next 2 to 3 years. How aggressively to restructure weak borrowers, whether to shift fiscal firepower from concrete to people, how candid to be with data, will decide if the country eases into a slower but stable growth path or confronts a sharper reckoning that would reverberate from Chilean copper pits to Silicon Valley chip labs. Either way, every investor, policymaker, and exporter now knows the numbers, grasps the stakes, and will be watching the next policy meeting, the next provincial bond auction, and the next property price print for clues about which road Beijing chooses.